Myles Bradshaw focuses on UK portfolios and pan-European strategy at Pimco. He joins me now. Thanks very much indeed for speaking to us. So I wanted to start by asking you about France, because we are seeing increasing concerns about this country in the markets, borrowing costs, insurance costs rising. Is it justified?
I don't think the spike out in CDS spreads, etc., and signalling a much higher probability of default is really justified. I think France's credit rating at AAA is probably under threat, but I don't think France is on the verge of default. I think what you're seeing, the real issue is the way the euro system works, and that's the focus of the markets, and that's what we need to see from Europe in order to stabilise markets, is much greater policy clarity about how the euro system, and in particular how Germany and France together are going to reform the European system to prevent vicious circles of liquidity crisis, creating self-fulfilling prophecies of greater solvency risk and ultimately loss of market access for sovereigns and whole economies, such as we've seen in Greece, Portugal, Ireland, Italy and Spain now.
So, Myles, what do then policymakers need to do to prevent that scenario from taking place?
Well, the first thing you can do is the ECB can intervene in the markets much more aggressively, and they can establish a clear floor and crowd in investors, and that will help countries such as Italy and Spain that don't face the same solvency problems as Greece and really face a liquidity crisis. If the ECB intervenes more aggressively, you can crowd in investors and you can stop the liquidity crisis from creating a self-fulfilling prophecy. That's the first thing. The second thing we need to do, though, is to see some kind of greater fiscal integration in Europe. The ECB can provide a liquidity bridge. The solvency solution has got to be through fiscal consolidation in places like Italy, Spain, and in France. And by providing fiscal integration in Europe, you can provide a more permanent mechanism for ensuring that countries don't get thrown off course because of a liquidity problem in the markets. And for that, we've got to see steps towards fiscal union. I think that's very clear. The EFSF exists. It suffers from a number of imperfections, in particular the way it's structured and its vulnerability to downgrades from one particular rating agency, its limited lending capacity, and the need to pre-fund in the market means that it's not really effective in terms of rescuing large economies such as Italy and Spain. And
all right, so Myles, let me ask you then, what happens when the EFSF takes over from the ECB with bond buying? How difficult, how complicated is that transition going to be, given that the EFSF doesn't have the firepower to deal with Spain, Italy, or indeed France if it came to that?
In the current market, where there's a great deal of volatility, where there's a great deal of uncertainty, I think the EFSF will be quite ineffective because they have to raise money before they intervene in the market. The way it might work, and this is thinking outside the box, is the ECB could intervene first and the EFSF could then issue bonds and to take those assets off the ECB's balance sheet. But the reality is that the EFSF was really the tool to solve the problem 3 months ago before confidence deteriorated. And now we need policymakers to step up and try and get ahead of markets. Constantly, policymakers have been reacting and doing too little too late, and we really need to see them to try and get ahead of markets. And that means really moving away from a levered, funded rescue mechanism such as the EFSF to something that is much more coherent, such as a common bond that includes institutional steps to actually force consolidation.
So do you think that the debate about euro bonds is going to be forced back onto the agenda? And even if it is, what are the prospects of it happening anytime soon, or indeed at all, given the language that we're hearing from the German Parliament? I mean, it's all down to them, right? Does that sort of language make you worry about the prospects for a fiscal union or euro bonds?
I think it's going to be extremely difficult. It's going to be extremely slow. But the key thing that can be sent by Merkel and Sarkozy when they meet on Tuesday is that they're now beginning to consider these things very seriously. We all know that common bond has been discussed through Europe for the past 12 months or so. And the key stumbling block is, in particular, Germany. And a signal from Merkel, in particular, would signal greater comfort in the markets with the idea that German strategy is changing. One thing we should not forget is the German opposition. The SPD, the Greens, which are the fastest growing party in Germany, are actually much more in favour of a common bond. So it's not the whole of Germany that is against it. It's not the whole of the German political system that's against it. And a signal that comes from Merkel would be, I think, would have a big impact on the markets, even if the details aren't immediately forthcoming.
Myles Bradshaw, Senior Vice President, Pimco Europe. Good to talk to you. Thanks very much.